Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Jane Buchan, I am so grateful to you for being on the show today.
Well, thank you for having me, Jonathan. You're someone I admire greatly.
Well, my biggest challenge in having you on this conversation is I feel like I could talk about you for hours, which probably is going to get in the way of talking to you. So let me do the talking about you as quickly as I possibly can muster, and then we'll actually get into the conversation. You're the CEO of Martlet Asset Management. Prior to that, you co-founded PAAMCO, a fund of hedge funds focused on institutional investors for 18 years. Under your leadership, the firm grew to $32 billion in assets. You've been an assistant professor of finance at Dartmouth. You've been a member of the advisory board for the Master in Financial Engineering program at UCLA. You have a PhD and a master's from Harvard University, and you've gotten your BA from Yale. How did young Jane see her future when she was 10, 15, 20 years old, and how did this life path actually play out?
That's a complex question. By background, my parents were professors of medicine, so I knew the one thing I didn't want to do was medicine. I heard enough of that over the dinner table. And I went to school, as you mentioned, back at Yale, but I grew up in the great state of Oregon, where there's a sport called track and field, or the British would say athletics. And I think almost every child's required to do that in Oregon. And I turned out to be okay at that. And so in school, I continued to grow. I grew with the boys. I continued to grow and turned into a pretty good Division I athlete. And so Wall Street finance, that was just nothing that was interesting to me. I majored in economics because it didn't require a lot of classes and they could count a lot of my math and physics and everything else. So that's what I ended up doing. And my advisor, pretty prominent guy who I think I just fascinated him. I came to him one afternoon after practice with a problem about how to solve a GLS problem. And we ended up hitting it off. And he took me aside and said, I was one of the few undergraduates to be advised by him. And he said, what do you want to do when you leave? And I proceeded to talk about how I thought investment bankers were evil people, because that's all I was exposed to. I was in school in the mid to early 80s. And he said, well, Jane, there are a few other careers in finance. So he sent me to New York to JP Morgan, at that point called Investment Management, now Asset Management, working for a former professor from Wharton. And I functionally worked like his graduate student. I mean, I was an employee of the company, but I worked on building models and I really got a good training in finance. And then for personal reasons, moved out to California and ended up at a very early age having to write a lot of models and solve a lot of real world problems, which was great because I could call my advisor at Yale. I could call my former boss, who was still helping me. I got to meet some of the faculty around in the University of California system, and I would call up and say, I've got a problem. How do I solve this? So I learned a lot. And as you know, because you also received a PhD, it's very easy to sit in a classroom and say, I got it. But when you have to sit down and actually create things and actually deal with the minute data issues, it's a very different world. So I learned those skills very early on and then went back to my degree and then started to teach.
Got it. And you, as I said, got involved in alternatives. You co-founded PAAMCO. And so let's dig into alternative investing. And I really think of the story of alts fundamentally is the story of markets over the last few decades, a move from public markets to private markets as a focal point of economic activity. And importantly, the story of the asset management industry. So how would you define alternatives?
A little bit of history, just because I think that puts it in perspective. But when I came out of school in the mid 80s, believe it or not, there were still pension plans, like state pension plans, that weren't quite sure if they could hold equities, if that was considered a prudent investment. And so what's happened over the years is people have broadened their investment outlook. And so when I think about alternatives, as not necessarily they're alternative to the traditional world. And the definition of alternatives varies. Like, I'm not certain that private equity today is an alternative. A lot of people have exposure to it. And so, what you have to think about is alternatives are out there on the frontier compared to different traditional asset classes. And the reason this exists is globalization. People don't talk about how globalization's affected investment management. And I think one of the biggest effects on globalization has been on asset management. I mean, you know yourself from when you manage a lot of money and when you were sitting here and looking. In the old days, you could have stocks and you could have bonds, and they were diversified. That's no longer the case. A lot of times they're moving together. The correlations and how they move have switched. And as people have started investing globally, the equity markets around the globe have become more correlated. They look more the same. So when we think about alternatives, we think about what are the things that are non-traditional. And so the very common alternatives today would be things like private equity, hedge funds. Newer alternatives would be things like private debt and venture capital, crypto, all these different things. And what slowly happens is alternatives grow up and become part of the establishment.
Yeah, I think that's right. And again, as I think about it as an economist, I think about it as tapping into the main vein of what human activity is about versus kind of the edge of that. Capital markets are about facilitating lending and borrowing on one side, and then kind of risk capital to actually grow things in a more aggressive way. That's kind of the main vein that's historically been traditional investing, right?
Exactly. And I think one of the interesting things about alternatives is there's alternatives in two dimensions. And so you get new security types. Private equity would be a great example, private debt, crypto. But then you get things that are new strategies. And so you get things like hedge funds, which often trade in a lot of liquid securities, but they're going long and going short. And when you go short, you get a different return payoff. You have different risks you run. And so you have to understand that. And so alternatives are things that are non-traditional, and the world changes. As you know, I was involved with CAIA, the Chartered Alternative Investment Analyst Association. I'm still a CAIA charter holder. I was chair of the board for a long time. And if you look at our curriculum over our 20 years, what you're going to see is a change as more and more things become traditional. And there's been a fair amount of work. If you look at the big institutional investors, where today up to half their portfolio might be in alternatives. And these are very big, well-resourced entities. But when you add up all these different alternatives, and the reason they're doing that is they're looking not only for better returns, but also for different risk profiles. And as the world has become more globalized, you get assets. Where do you go to hide? Where do you go to diversify? And just using cash alone is a very, very costly solution.
Yeah. And you just brought up the distinction between private equity and hedge funds. And I agree with what I think I'm hearing, which is private equity barely qualifies as alternative because it's become such a large part. Again, markets have gravitated away from public towards private. So there's just more of it. And if you think about the functional reality on the ground, private equity is still equity. It just happens to be levered equity, which doesn't change the underlying return profile pre-leverage, as opposed to a long short equity market neutral portfolio that is designed to go long stocks and short stocks and arbitrage in some way, shape, or form, mispricings. That's kind of what I meant as the edge of this conversation, which is it's not the deep vein of capitalism, is just making sure that the system kind of runs efficiently. And of course, then it brings the issue of capacity, right? Which is, hey, you can only do so much of this stuff because realistically, the system only needs so much of this stuff.
Exactly. But you think about the markets today. The markets today, and we've had several experiments because post the great financial crisis, the GFC, there were several countries, you know this as a well-trained economist, finance person, they put restrictions on sort of short selling. And so we can compare what happened. And for example, what we see is that where the capital markets are free and people are investing across all the capital markets in different sorts of strategies, the markets are more efficient. And if you're a company, think about, the great American dream. I mean, this is a country, I travel a lot around the globe for my work in terms of working for Standards for Alternatives and working on education and alternatives. And If you think about it, the great American dream is still where the center of capitalism is. And what's great about this is if I'm building a business here, I know I can access our capital markets and they're going to be more efficient, which in English means I get a fair price. People may disagree with me on what the price is worth, of course, but the point of it is it's a fair price. It's a market-driven price. It's what the market thinks about it. And that is so important in the capital formation. And if you have markets that are highly regulated, where capital can't move, people are scared to make those decisions. And that's why it's so important to have all these markets where people can take out the arbitrage opportunities. And of course, you get paid for that.
Yeah. And so there is kind of feeding the main beast of entrepreneurial pursuit in capitalism. There is keeping the system healthy by trying to arbitrage away the issues at the margin. And then I guess there is, again, the unintended consequence of the fact that we live in the real world, things like the fact that regulation might get in the way of certain outcomes. And then we get into what I would describe as regulatory arbitrage. The poster child of that today as being direct lending and private credit, where we've told a certain set of entities, hey, don't do the lending thing. Guess what? The lending thing's going to happen. It's just going to migrate.
Yeah, but I think you have to be fair about this. And one of the things that's important is if you think about the world that I grew up in, and is that the banks were all powerful. And whether they were investment banks or commercial banks, that's where we held and kept our money. But the reality is the banks have always only been intermediaries. They haven't been the end holders. And one can argue what's happened. I mean, sure, there are things that don't make a lot of sense and there are regulations that I would change immediately. And, the markets aren't perfect. But in general, what's happened over the past 40 years of my career is what we've seen is that the assets have gotten into the holders of the long-term holders, the real investors. The pension plans, the individuals. And that's a much safer place than to leave them, in my view, in the intermediaries and try to regulate away the risks. I was on a trading desk in 1987. The stock market dropped 25% in one day. I mean, it was crazy. The tapes were running hours late. I mean, that sort of thing doesn't happen today. And if you look at even some of the chaos that happened around COVID, yeah, it was a sharp down, but it was a pretty good sharp back recovery. And we have systems today that if we're going to live in capitalism and in capital markets, we need fluid, active capital markets. Sure, occasionally we pass rules that don't make a lot of sense. I mean, that's always going to happen. But if you look at it over a 40-year history, what we've done, I think, has gotten to a much more stable environment.
No, I think that's right. And one is, again, there's a inherent tension between allowing certain players to play specific societal roles and say, but by the way, because you're part of the societal fabric, there are rules placed upon you, and the fact that it might actually give a monopoly power that can be misused, certainly at the margin. The other thing, which you just highlighted, aligning who owns the asset with who decides whether the asset ought to even come into the world can be really helpful. Larry Kotnikoff, who was my dissertation chair at BU, wrote a book after the financial crisis called Jimmy Stewart is Dead. And he had this great notion, which is let's just do away with banks and let's make everything to a mutual fund, because mutual funds are kind of a blob. They can suffer gains and losses and all of that. Banks, of course, make it or break it. I think in a lot of ways, Larry was right. The future belonged then to more fluid, more flexible structures.
I agree with it. But I mean, one of the things that's really important about alternatives is they are alternative, which means they're kind of outside the system. I like to think of alternatives as the equivalent of children. When they start and you come up with new strategies, and that's where a lot I did our investing activities at PAAMCO, were new managers and new strategies. You're really out there in the new world. You're not following somebody else's path. You have to ask a lot of questions. And where I've seen mistakes happen in this industry is when people try to do it themselves because they don't understand a lot of pitfalls. And I mean, we were professionals and ran a very healthy business with some of the world's biggest investors as clients, and we still made mistakes. Fortunately, we made many more good decisions than bad decisions. But you have to spend a lot of time on that. And that's sort of like the adolescent. Think about your adolescent. I know you have kids, but a couple more years and they're driving and dating. That's the leading bleeding edge of alternatives. Then they kind of grow into maturity. They're buying the house, they're starting a family, they're doing all of that. And that's when you start seeing competitors and you start seeing more institutions come in, you start seeing high net worth capital come in, and you can actually compare firm A to firm B to firm C. You still don't have quite all the rules of the road. And then you kind of get into what I would call the older group. The kids have gone off, they know what life is. And, for example, if I'm putting it this, crypto is clearly the adolescent. I would argue private debt is clearly the young family. There's some rules going on, but not everything's totally formed. And then you get private equity, which very much to me is the equivalent of the kids have gone off to college and it's kind of very set. And what you have to understand when you invest in alternatives is it's not whether an alternative is good or bad. There's life cycles of these things because they come part of the establishment. I mean, when I started, international stocks was considered an alternative. You had ADRs, American Depository Receipts, because it was too scary to send money overseas. I live in this world, and that's what I love about the world of alternatives, is you're constantly learning. You can never sit back and say, oh, we've got the whole frontier mapped. There's always new things coming up.
Well, yeah, the frontier keeps evolving, right? It's to your point, is this the kid just hitting the highway for the first time, or is this an adult with a life insurance policy? I guess the best way to describe it using everyday terms is you are looking into their background, you're looking into their practices, which is in our terminology, we'd be calling that due diligence and risk management. And I guess that's what it takes, right? When I think about investing, I talk about the mechanics, the psychology, and the purpose of it. At the top of the list on the mechanical front is due diligence and risk management. That would have been my shorthand for what PAAMCO did from the outside.
I mean, it was really important. And what we worked on was, in addition to looking at new strategies, but also taking risk off the table. So, for example, we used a lot of separate accounts. So the manager couldn't do things with our money that we didn't want things done. That was an easy risk to take off the table. And right now you're seeing a huge increase in separate accounts because people are understanding. And sometimes the fees are more expensive, sometimes they're less. For us, because we were very large, it was a way to cut a lot of fees out, and you're always trying to do that for the benefit of the client. To the extent that you can substitute your judgment and knowledge and reduce fees, that's wonderful. Or else you can go hire a consultant for very little and pay a lot of fees. And our clients were clients that wanted to reduce the overall fee load.
Yeah. And again, with separate accounts, you manage another form of risk, which is custody risk. You actually know where the securities are, where they're housed, what jurisdiction, so on and so forth, which, as we all know, that becomes one hell of a risk once in a while.
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode.
I was telling a story slightly out of school. I'm involved in a lot of boards, both nonprofit and for-profit now. We were planning an audit, and we were meeting with the audit partner of a smaller firm, and he asked if the entity invested in crypto. And I said, no, we didn't, because we're a fiduciary. And he goes, well, why? What's the issue? And I said, custody. The rules are still very vague. I mean, granted, they made a lot of changes in the past 2 months, but the laws are still very vague on how you handle custody. And he goes, I've never heard that. Everyone talks about the risk. And I'm like, no, these are real risks. It's not only do you have the investment strategy, but you have to think about the people or the machines that are executing it, who's maintaining the machines, how you value the securities, how you trade the securities. It's the entire waterfront. It's not just analyzing strategies. That's a very simplistic view of the world.
That's right. It's not just the volatility of the thing, is where does the thing live and the jurisdiction and all of the above. I tend to worry perhaps more than my fair share. So, I want you to call me out if you think I'm overly worried. But one of the issues that I think we often see is because alternatives are often a good ground to tell a good story, I perceive that there are what I would describe as kind of focal points that happen. And all of a sudden, the good and the bad are hard to distinguish. And maybe too much capital goes into a thing. So I worry about alternative bubbles in a weird way. I don't know how to describe it. It's almost doesn't make sense because the whole point of alternatives is they should be in the outside of the system. And so they shouldn't be able to kind of have societal impact. So how do you think about that concept?
I mean, first off, there are two things, and they certainly exist. But remember, in the concept of bubbles, like people talk about the stock market. I'm sure this happens to you all the time, given your business of advising people, but they worry about, is the stock market a bubble? Well, sure. I mean, I lived through 1987 on a trading desk where we lost 25% in a day. I still was better at putting my money in the day before that happened today to hold stocks long term. And you can talk about it as a bubble. Another example, you hear the stories about 2000, pets.com. People joke about, oh, look how stupid those internet stocks are. Look at today. So when you think about bubbles, I think people worry too much about trying to hit the perfect timing. And, what you have to remember, or at least I always remind myself this when I'm investing, is I'm going to make a bunch of wrong decisions. And anybody's going to make a bunch of wrong decisions. The important point is with every decision, nothing is a home run. Sure, some are going to work out better and worse, and you want to think about the risk management on the downside. But then the second thing is you want to be roughly right over the long term and not worry over any one individual decision, sort of the fish that got away. And so there are alternative bubbles. I can name a whole bunch. And I worry, I had a piece in the FT about 18 months ago where I'm talking about, we're in this environment where private credit, we've dislocated credit out of the banks into the hands of asset owners, which I think in general is good. But we haven't figured out when companies default how this all works. And when you talk to a lot of asset managers, their strategy is they're going to sell the bond. And the question is, to whom? And, I think there's certain things that still need to get worked out. But no investment's perfectly safe. Even U.S. Treasuries aren't perfectly safe. We've seen some big drops in those over the years. And I think that's why you need a lot of expertise and need to work with people who are well trained in the space and can ask a lot of questions. Investing in alternatives is not where you want to work on brand names or where you want to just do cursory research or read some analyst report. You need to understand what you're doing, why it makes sense, and ask basic questions.
Yeah. And part of it is, the risk management because it's the nature of my training and the way I think. There's the individual implication. There's the societal implication. Job number one, of course, is the individual implication. Can you have a bad outcome and live to fight another day? That's kind of on the ground risk management. And then there's, of course, the macro prudence component, which is, can this blow up the system? But if you even set that aside for a minute, a lot of it is psychology. You buy the S&P 500, it goes down 20% next year. You don't feel like a total idiot because you just kind of were part of the main vein of investing, and you have a belief that you're probably still okay. Once you move out of the main vein into alternatives, then the psychology comes in 11 out of 10, right? Because if you get a bad one, you're like, I was a real idiot.
Yeah, and I think the industry, we have not done ourselves a good service because you know as well as I do from the math that sometimes it's better to have a diversifying asset with a lower return than necessarily have a very correlated asset with a high return. And I think people think alternatives, they magically think of that something that's compounding at 30, 40% or some astronomical figure. And that's not why alternatives exist. I mean, there are things that have different risk and return profiles than what you find in traditional markets. And they do that because of the instruments or because of the strategies or some combination thereof. But it's diversified. The best lesson over the years for investing is to be diversified. You don't even want to put all your eggs in the S&P 500. I think America's fantastic. I think our stock market's fantastic. But what are you going to do in those down years? Can you survive? Most people hear markets don't repeat, but they rhyme. And we've had years where you've had 3 and 4 years back to back of negative returns on the stock market.
Yeah. I mean, and by the way, again, you just talked about private credit. I have nothing against private credit. And to your point, I think in a lot of ways, moving the ability to do lending out of one channel into multiple channels and having people making decisions on the allocation, actually holding the risk, all that seems pretty good. I get worried when the magical thinking, and this is where I get not just worried, but angry, when the magical selling happens. I think about 2022 as having given some magical selling attribute to private credit. It was the one asset class that did very well in 2022, obviously, as rates were rising rapidly. And it wasn't magic. I mean, it was diversifying for sure in real time. But hey, when you've got a floating rate asset class, that thing will kind of do that. It's not magic, right? So that's the thing that I worry about, is when the expectation massively outruns the reality on the ground.
I mean, I like private credit, but in moderation. So let me just be crystal clear. I believe in diversification. I've always believed in diversification. But, there weren't a lot of fixed income instruments out there until recently where you could get floating rate. And that's where it's become an alternative, because this is something that built the back of banks. Banks have always had for a long time floating rate paper, but it wasn't out for the public consumption. And people talk a lot about democratization, and honestly, I don't buy a lot of it. I think a lot of it is code words for crypto or something like that. I think the real democratization is we're taking out intermediaries across the board. I mean, there's much more democratization in fixed income than in crypto.
I think that's exactly right. I think the words, the labels sometimes get in the way of the reality. I don't think of private equity as private equity. I think of private equity as levered equity. And I think of private credit not as private. That's great. I'm happy for them that it's private, but more to the point, it's floating. Those are kind of the more fundamental economic attributes, if that makes sense.
So it's been an interesting place to have a career. It's very intellectually exciting. I know you've done a lot of investing in the space and you're very experienced, and it's just a different skill set because you're constantly learning. You get some basic information, but because it's out there and it's newer, you're constantly in the flow of new information.
Yeah. So obviously, as I said, I admire you in infinite ways, but one of the things that I do admire about you is your work in the community, a lot of it having to do with promoting women financial literacy, as well as improving, let's just call it the pipeline issue in financial services when it comes to women. You and I are involved in WISE, Women Investing in Security and Education together, which aims to do just that, empower women of all backgrounds with financial knowledge and encourage women of all backgrounds to join the financial services. When you think about that question today, what advice do you have for women thinking about a career in finance?
My advice goes beyond women. It goes to anybody who's thinking about a career in finance. And I think the important thing is to ask a lot of questions to start out. I did sports, as I said early on, and I've had this conversation with a lot of relatively high profile names almost everybody would know that I've had the opportunity to meet over my years. And one of my favorite subjects is that, you're a guy, and I don't know, you grew up in France, so it may have been different. But here in the U.S., if you grow up and you're a high school boy and doing a lot of sports, you walk in a weight room, there's still the presumption you know what to do. Mm-hmm. I had the advantage because I was a girl, walked in the weight room. Okay, what am I supposed to do with these things? How do you lift? And because of that, I actually learned how to lift more correctly than a lot of the guys because I asked the questions. Having that freedom to be able to ask, why is this happening? And, we get this. People get all these big fancy letters after their name, and they take all these exams and get all sorts of qualifications. And then they think they get the pressure on themselves to know the answer. And I've just always been really curious. I think I'm reasonably smart, but, I'm always just more curious and like, why is this working? Why? And asking those questions is really important. And I think where people get themselves into trouble is when they can't get good answers to things and they feel embarrassed that they have to know the answer. And trust me, I've been around a lot of super smart people. My dissertation chair won a Nobel Prize in economics. Pretty smart guy. Yeah. I see him ask a lot of questions. I know you know him very well. And it's just to have that freedom and the empowerment to ask questions and keep asking until you understand or you get an answer you like. And too many people feel like they have to keep up appearances.
I think that's right. And as you noted, I'm French, so this squarely doesn't apply to me, but I was reminded recently of the kind of the spoof book, Real Men Don't Eat Quiche. And the whole thing is like, hey, you're projecting this appearance of knowing what it means to be in the spoof version of it, a real man or a real professional or a real expert. And that always gets in the way of a good outcome, as opposed to saying, what's going on here? Explain it to me. I think I got it, but can I try to explain it back? And then call me out
Yes.
where, and I think that's really, really important. I feel like I've asked you a lot of questions and I'm incredibly grateful for your time. I have one final list of questions. Again, I grew up in Paris. I was bathed in French TV and there was this amazing cultural TV show hosted by Bernard Pivot and he asked the same questions to every guest. And of course, James Lipton adapted these questions to American TV for the Actors Studio. Are you ready for a series of rapid fire questions?
I don't know. French intellectualism. This seems very dangerous.
Oh, you've got a little practice. I think you're going to be okay. What is your favorite word?
Why? Why?
What is your least favorite word?
No.
What is your favorite drug?
To read. When everything's not going well, to get into a book. I love to read history. I love to read science. Oh, to read.
Yeah, we've talked about your passion of history separately. What sound or noise do you love?
Oh, the ocean. I grew up on the West Coast. The sound of waves crashing. It's peaceful. It's calm. I know I'm home.
I feel the same way. What sound or noise do you hate?
Oh, styrofoam. I can't stand it for some reason. And people pack stuff in styrofoam, and I have to give all my presents to my husband or my friends. If they open it, I'll come back in the room once it's open.
What is your favorite curse word?
Oh, mon Dieu. I don't know.
Who would you like to see on a new banknote?
I would love to see a community, not a person, because we're a community first. And I would love to see a banknote with a group of people. I just think we're losing something in today's world. My husband works with high school and community college kids as an athletics coach. And it's just like they text each other. We've lost the sense of togetherness. And I'd love to see a group of people.
I love that. I think community is critically important. And you're right. I think the focus on the individual is probably hurting more than it's helping. What profession other than your own would you never, ever want to attempt?
Oh, that's easy. Being a cook, a chef. My husband's skilled in that. But in full disclosure, I once lived for 6 months without a refrigerator when I lived on my own because I bought every meal outside. I am absolutely all thumbs in the kitchen.
All right. If you were reincarnated as a plant or an animal, what would it be?
Definitely would be an animal because I would want to move. I don't know. That's a really, really good question. The name of my firm now is an imaginary animal, so maybe a martlet. And the martlet flies around the world. It's imaginary. It has no feet. It can't land, but it's always in the quest of knowledge.
Love it. Well, one last question. If heaven exists, what would you like to hear God say when you get to the pearly gates?
Welcome.
I love it. Well, Jane Buchan, this was a fabulous conversation. I'm incredibly grateful.
Thank you, Jonathan. You're just amazing.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, .treussard.com, for additional information and disclaimers.